The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, Wednesday's market trade was relatively quiet, just not a lot of fresh news out there to really chew on. Grain markets drifted their way mostly lower, led by Kansas City wheat. Cattle futures had a good day, and we got the latest Federal Reserve news as they left interest rates unchanged in the month of March, but some interesting policy moves they made. We're going to talk about all of that. Joining us now for market analysis, Mike Zuzolo with Global Commodity Analytics. Mike, good to catch up with you again this week as I know we have some weather moving through the Midwest, a lot of folks getting impacted by that, and I think that might have played a little role in the wheat trade Wednesday. We'll get to that in a second. Let's start with the Fed. As I mentioned, they left interest rates unchanged, but they did make some other tweaks, I guess I would say. What did you gather out of the Fed news here on Wednesday afternoon?
I think it could be a very interesting Globex trade on Wednesday night, Jesse, because while the Fed, as you say, did not change interest rates and kept us at the 4.25 to 4.5 band, we did see a reduction in the 2025 GDP. We went below 2%, which is traditionally you go below 2%, you're in recession territory. They went from 2.1% to 1.7% today on their forecast for growth. And then an interesting note here, they took inflation up, which that's kind of counterintuitive. You typically need strong growth to be able to get a higher inflation, but they took inflation up from 2.5% to 2.7% by the end of this year. And so it's a true stagflationary type mindset that the Fed gave us today. I'm going to be very interested in their press conference. And as I said, very interested in the Globex price action. I think that looking at this at face value, if you see lower growth and higher inflation, I would think that would be negative for Wall Street and negative for the US dollar, which that last thing I really want a lot because it really came roaring back on Wednesday's trade between Fed expectations and also I think what's going on with Russia and Ukraine. We saw the dollar come back in as a safe haven, in other words.
Well, outside of the Fed, again, there wasn't a whole lot of fresh news, it felt like, on the day Wednesday. But let's lean into a couple things we do have to take a look at. Weather, I think, was one of the key things we maybe watched on Wednesday. It felt to me that we maybe took some HRW premium out with this snowstorm moving through and rain showers and more. But, I mean, you look at the drought concerns in the plains, drought concerns overseas. I mean, what stands out to you when you take a look at the weather situation, Mike?
Well, you look at this map, and first of all, what this map says by NASA is you're talking about the top 1 meter of soil in key growing areas of the country. In fact, almost all the key growing areas of the world, I should say, including our country, excluding China. I left China off of this on purpose. But you see that the roots zone soil moisture for the first 1 meter of soil is at 2 to 3 to maybe 4% in terms of wetness compared to normal and compared to the long-term average. And I just, it came to me Wednesday when I saw the hard red wheat break, like you were talking about, we're really wasting an opportunity here for the weather market to find some real roots and to find some real basing here and see some new longs come into this market. And the only reason that I think would be justifiable when you look at this map, I mean, look at the upper right-hand corner. I've circled the Black Sea. And I mean, look at Turkey and Ukraine and Western Russia. They are beet red as far as dryness right now. And we continue to see lower exports and lower forecasts come out here in the last couple weeks for that part of the world. And I think the only thing that would make sense to me at this point as to why we're kind of whistling past this weather drought graveyard globally is the fact that South America is harvesting something right now. And more importantly, we're getting close to what I call T-Day instead of D-Day, April 2nd, the new tariffs. And I just got to think that the market is rushing ahead, skipping over the acreage report, skipping over the stocks report, skipping over this weather situation. Even if we got some rains here in the United States for the hard red wheat belt, we're still looking very dry going into April. So that's kind of how I see it here at midweek, and kind of makes the end of the week very, very important to me.
And I'm glad you brought that up because I've been asking the question, have the markets maybe been marking time until those USDA reports and, marking time to see what spring weather in the US looks like. But to your point, sounds like we might be even jumping ahead of those things and focusing more on the headline news risk in the markets, Mike.
I think so. And I think what kind of adds to this, and adds support to this idea, is that we've had a couple private trade estimates on the new crop acres. They really haven't deviated from much from 94 million corn, 84 million beans. And the trade, I think you probably heard this as well last week, but I've heard a lot of traders and analysts talk about, that's the smallest corn acreage number. It's going to be 95 plus. Well, we're not hearing that yet. We're really kind of stuck in low gear at 94 and 84. So the idea of buying beans and selling corn and working the opposite of the spread that's been so effective this last 3 or 4 months, I think it just kind of died on the vine on Wednesday. And I think we've got a lot of Brazilian weather to still talk about. We still don't know what the Argentine crop is for the corn, especially. And so corn seemed like it gained its mojo back on Wednesday with the spread, the July D spread, bouncing off a really critical support level of about 12, 13 cents premium to the July. One of the things we really want to watch for in April, because the March is now off the board, Jesse, and May is now lead month futures, is we get into planning. Historically, we can really change the dynamic and the look of the futures contracts, where we take the premium out of July and stick it into the new crop December, because we say as a market, look, we've got enough supply to meet the demand. We're going to give you extra premium to store. Don't sell it, hold it, and we'll pay you to store. That's that carrying charge market, or what the funds like to call the contango market. So I'm watching for that, but right now it doesn't seem like we're ready to go there yet.
Want to focus in a little bit more on HRW wheat. Again, that was the downside loser on Wednesday. This is an annual HRW chart that we are taking a look at. What are some of the key chart points, technicals, fundamentals you're going to be keeping an eye on here when it comes to HRW KC wheat?
The key about this chart is it kind of blends together with the idea of wasting an opportunity for a weather-led rally, because of the United States and Russia and Ukraine all under a drought threat right now, and it's not looking any better heading into springtime, with dormancy breaking here in the States and a real questionable weather pattern. But this annual chart really shows a lot. I mean, if you look at what we did earlier this week in hard red, we were able to make new monthly highs for the month of March, but we weren't able to take out the February high, which is also the 2025 high. So the last bar you see, the small black one, that high is 630.5. And the only thing I'd say about this chart is you're right up against a moving average, trying to figure out what you want to do for a trend. And secondly, and more importantly, you take that 630.5 level out, you really have very little resistance on an annual basis until you get above $7. And I think that's the kind of chart that I really want to keep an eye on, so that if we do break out, we don't, set our sights too low for what the potential upside is. This chart would suggest if you get above 630.5, it's not going to be too difficult, unless something big changes with the tariffs. Given the weather, we could be able to get closer to $7. And I'm really on the hunt right now to get some wheat hedged for 2025, because I'm essentially zero hedged in 25 wheat and zero hedged in 25 corn. And all my new crop bean hedges are in the old crop right now.
I do want to ask you real quick. I just had this thought come to me. Another thing with this wheat picture, I'll jump back to the NASA root zone map, and I see a nice big red blob in the Red River Valley of the North, and then a lot of that scattered in the Canadian prairies. And thinking about spring wheat as well, I have to worry a little bit about the dryness and drought concerns and what that could do for spring wheat.
I couldn't agree more. And I think this is where it goes back to the acreage mindset. If you're going to lose corn acres, if you're going to gain corn acres, it's going to be on spring wheat acres, and it's going to be on ripping up soft red or hard red wheat acres. And I think that's still a very viable candidate to raise the corn acres. I think we will be above 94 million. Can we be above 95? And I think it would take a continued drought to get us to that point. Not only do we switch a little bit more over and keep running the corn planters, but we look at the wheat and say, I don't want to keep this scruffy stuff. I'm going to go after corn and go for broke.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Let's take a look at some of the prices at the Gulf for corn and soy. I know when it comes to the export picture, corn seemed like it's been fairly decent inspections and more here as of late. Yet I know seasonally we're getting out of our, especially out of our soybean shipping window. But I mean, you think about the tariff conversation, more thrown in here. Let's talk about some of our price competitiveness. Let's start with the corn side. What are you seeing in terms of futures versus that Gulf of Mexico cash price?
Yeah, I think the one thing that really is standing out to me right now, and I read this in a Newswire story earlier this week that related to what I'm about to talk about, related to the copper market, and a metals trader talking about how the futures market is really putting into the prices U.S. versus London copper, the tariff issues that we're looking at, whether it's 20, 25% or 10%, we're really starting to see some spread trade related to the tariffs. And it was interesting to me this week that we're now back to a European wheat futures market that's 673 against our 563 price in soft red wheat. And on our corn market, the European price in the futures in France is at $6 against our $4.60 price. That spread of about $1.40 in the corn is the highest since November of last year. And I think this speaks volumes when we look at this kind of a chart where we look at the Gulf. And I'm not being political. I just forgot to change the Gulf of Mexico. I know it's supposed to be Gulf of America right now, so please forgive me out there. We're looking at 529 on the cash price at the Gulf versus 462 in the futures. I just got a text message before we went on air that a major ethanol plant back east on the Indiana-Ohio border jumped their basis by 20 cents on corn. I've noticed that another big ethanol plant in Blair, Nebraska, has been popping their basis as the corn futures is going down. We're not seeing that cash market lead the futures lower. So here again, I want to see how we all look in terms of the wheat weather at the end of the week. And maybe, just maybe, we're starting to find some cash-led strength that would, maybe call a bottom in this market until we do get to the end of the month, 1st of April.
How about on the soybean side? Let's take a look at that chart, looking at the same thing, the cash price at the Gulf versus lead month futures. And, I think about looking at this chart versus the corn chart. They look similar in the fact to me that they're both seemingly moving in conjunction. The two are the cash versus the futures.
Yeah, less of a divergence in the soybeans. And this makes sense because we do have extra soybeans domestically. And we, I think, can say at this point we're going to have a better South American soybean crop than corn crop. And third, I think we're all very nervous. I'm very nervous about what happens between the United States and China when it comes to the tariffs and whether China really goes after South American soybeans aggressively, whereas with the corn, we've got Mexico underneath us and some of the other Asian countries. So, and obviously Canada and ethanol is a big issue, but when it comes to outright exports, I think we've got more cover in the tariffs with the corn. And I think this chart kind of shows that.
All right, let's go over to the livestock trade and talk about cattle. Mike, this cattle market, here we go again. I mean, getting us back up, setting some new contract highs in futures this week with live cattle futures back over 2, feeders surging higher. I mean, what are you seeing in this cattle trade here mid-month? Let's start on the live cattle side.
Yeah, I love this annual chart because it really is a great chart to kind of rein us back in terms of how high can we go. And later tonight, when I put this video out on the blog post, I'll be adding some price objectives to get some hedges in place for cattle and feeders, maybe by the end of this week and before Friday's cattle on feed report, Jesse, just because I don't think we're going to have as good a summer grilling season. And we can talk about that here in a minute. But this chart really shows a lot. When you see the run from the 2010 low to the 2014, 2015 high, you're talking about 5 years higher. We're in our 5th year higher right now. When I talk cycles and I talk seasonals with you and with others, this is the kind of stuff I look at in terms of what did we do back in history? How much higher are we in fat cattle than the 2014 highs? And you can see what the egg prices have helped do for us, and some of the other fundamentals that have helped us get $30 plus higher than our highs back in 14, 15. So I really think that the idea that I had maybe a month and a half ago that I think I shared with you, that I sense a very strong viewpoint that by the time the April fat cattle go off the board, we'll have a high or the high in place for the cattle market. I'm still on track with that because this recent move up, this cash-led strength, thanks in part to the blizzard, thanks in part to the hogs playing ball with us, with some other fundamental news about a month ago, and thanks in part, obviously, to that cash market and the short bought packers here recently.
We have another chart to look at, and this one is an interesting one. It's looking at the average steak price versus live cattle futures versus the S&P 500, and cool correlations to take a look at. What are you watching here, and how does this tie in with the cattle futures and the cash market and the retail demand and more? What are you tracking here, Mike?
Yeah, the neat thing about this chart is if you look at the bottom line, that's your S&P futures, and it's not as easy to see as the top chart because it's shrunk. But when we had the big break in 2008, 2009 with the financial crisis, and we had the pandemic hit us, and we had a pretty substantial break in the S&P 500, you see the steak prices go down, and you saw the cattle prices not go down during the pandemic as much because of the shift in the supply chain and the demand side just coming on so terrifically. But this really kind of comes together with the updated Federal Reserve numbers we just talked about. If you're looking at weaker economic growth and you're looking at higher inflation, that's demand rationing 101 right there, Jesse. So I just don't see as strong of a summer grilling season here this year than what we had the last couple years. And I also think we're going to be past the egg shortage situation by the time we get to the middle of the summer. So I'm looking for reasons why the April cattle would be a key area or time period where we put a high in place. And I'm looking for reasons why it wouldn't be. And so far, my list is pretty long as far as why I think that we're going to have a top end market by the time April goes off the board. And I have to throw this out too. Feeder prices are still very much red hot, but we're getting wrapped up on the feeder sales at this point. So there's just not going to be a lot more supply out there. And those placements numbers, those expectations on the cattle on feed report are suggesting that. But, you know, Torrington, Wyoming saw some 7 weights go for 322 today. Bassett, Nebraska saw some heavy 5 weights go on steers for about 325, I think it was, or excuse me, 375. We're still red hot in the feeder market, but I think that too will come to an end eventually.
That's good thoughts. And thinking about that summer grilling demand, that BLT seasonal, as you and I like to talk about. I mean, I'm still going to do my best to have a little bacon and steak on the grill. But to your point, I know the overall economic picture. When does the rubber meet the road for some folks, Mike?
Yeah, and I was really blessed because I had a client that was raising some beef cattle, and he contacted me about 6-8 months ago, and he said, "Would you like a half a beef?" And I said, "Yeah, I would." And I just picked it up because of the weather, and so we're really sitting nicely for the summer grilling season here, thanks be to God. But I really think that the consumer out there is going to be very stretched this summer compared to the last 3 years. And I think circling all the way back around to the Fed and circling all the way back around to the biggest concerns we've had all year, Jesse, has been that dollar being a safe haven. It's not been so far because of the tariffs. Maybe the Fed will help keep it lower for a while as well. But I think eventually, given the geopolitics, we probably should be starting to bet on the idea the dollar could become a safe haven bid again.
I should ask you also, before we wrap up today, NASS on Wednesday announcing they are reinstating the July cattle report and county estimates for crops and livestock as well. What did you make of that news, Mike?
Great news, great statistical data news, because they're going to be a lot more reliable now, and you're going to be able to track down where the errors are. Jesse, we pulled out several 100 million bushels of corn ending stocks over a 3 or 4 month time span. we did the same thing with the cattle market and the bean market. I mean, we looked at, what did we look at? A 9% adjustment in ending stocks within 3 or 4 months for the soybeans. That's because they didn't have the statistical data. And I think this will bring the farmer back on board with doing the surveys as well, which has been very sorely missed in both cattle and in corn. I've heard that in both the rancher and the farmer as far as filling out data and surveys.
Mike, good stuff as always. Any final thoughts you would mention or reiterate to folks today?
Just enjoy the blizzard, the last one maybe of the year.
Well, as folks are enjoying the blizzard in parts of the Midwest, if they want to reach out to you, take a look at your analysis, get a free trial, etc., how can folks do that?
Yeah, globalcomresearch.com, and it's globalcom with 2 M's, research.com. Get a free 2-week trial. I'll contact you once at the end of the trial.
Mike Zuzolo, Global Commodity Analytics. Always good to hear from you. Enjoy the week. We'll talk to you next week.
Thanks for having me, Jesse. Appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.